Hi there. In this video, we explain how settlor-interested trusts can create unexpected CGT exposure for UK taxpayers.
Picture this. You're a successful UK business owner. You've worked incredibly hard for decades to build your company, and naturally, you want to pass it on safely to your family. So you pop your shares or maybe your property portfolio into a family trust, thinking, great, safe and tax-free for now, right? Well, imagine HMRC suddenly knocking on your door, handing you an enormous, immediate tax bill with absolutely zero cash from a sale to actually pay it. Welcome to this explainer prepared by the expert tax advisors at Fairview Accounting Services, or FVAS. Today we're diving into a massive, fast-approaching trap for UK wealth creators where trying to defer tax results in a brutal, unfunded, dry tax bill. If you hold significant business or property assets, you really need to hear this before the monumental tax shifts of 2026 and 2027 kick in. I'll just put the business in a trust for the family. There's no tax if I don't sell it, right? It's such a common misunderstanding. And honestly, it sounds totally logical. If no money has changed hands and you haven't actually sold the business, why on earth would you owe tax? Well, today we're going to dissect exactly why the incredibly complex rules around trusts make this assumption a very dangerous, very expensive trap. The old assumptions simply do not apply anymore. Section 1, the settlor-interested trust trap. So, what actually creates this giant tax liability? It all comes down to a highly specific legal label, the settlor-interested trust. Basically, under UK law, if a trust's property or income can benefit you, the person making the trust, your spouse, or your civil partner, it gets this label. But here's the kicker, and did you know this? Simply having a minor child, meaning an unmarried kid under 18, as a potential beneficiary instantly makes it a settlor-interested trust. HMRC uses a deliberately massive definition to stop tax avoidance. It catches even the tiniest, most remote possibility that your immediate family might benefit down the line. Section 2. Blocking CGT holdover release. Here's where the time bomb actually starts ticking. Normally, if you gift an asset to a standard trust, you can use a brilliant trick called holdover relief. It basically pauses the capital gains tax, passing your original base cost to the trustees. You only pay up when they eventually sell. But Section 169B of the tax code completely blocks this relief if your trust is settlor-interested. So what does that mean for you? It means you get hit with an immediate 24% capital gains tax charge on the asset's current market value. And remember, you didn't sell anything. You have no cash from a buyer to pay for this. We call this a dry tax charge. Imagine putting a £2 million property into a trust for your kids and suddenly owing HMRC nearly £500,000 right out of pocket. Section 3. The 6-year clawback rule. Okay, this part is a nasty surprise that catches a lot of taxpayers out years after setting up their trust. Let's say you do everything perfectly in year 1. No minor kids, you exclude yourself entirely, you're safe, right? Not necessarily. The law has a super strict 6-year clawback window. If that trust becomes settlor-interested anytime within 6 years of the gift, boom, that deferred gain is violently clawed back. How does that happen innocently? Well, maybe in year 3 you have a new baby, and the trustees naturally add them as a beneficiary. Instantly, by the letter of the law, the trust is settlor-interested. By year 4, a massive, retroactive capital gains tax bill lands directly on your doormat. Section 4. 2026 Business Relief Changes. Now let's talk about why the radical changes coming in April 2026 accelerate this whole problem, especially if you own a trading company or farm. Historically, Business Property Relief, or BPR, gave you a highly generous 100% exemption from inheritance tax. You could drop a £20 million business into a trust with an absolute 0% IHT entry charge. But look at this. Starting April 6, 2026, the government is capping that 100% relief at a strict limit of just £1 million. Anything over that only gets 50% relief, meaning if you put business assets worth more than £1 million into a trust after that date, you're going to trigger an effective 10% inheritance tax entry charge on the excess. A lot of folks completely overlook how these rules interact. Let's do the math on a large gift into a settlor-interested trust in 2026. Because holdover relief is blocked, you pay 24% CGT on the growth. Plus, because of the new cap, you pay a 10% IHT entry charge on the value over $1 million. Combine those, you're looking at a staggering 34% immediate tax hit. And again, this is without receiving a single penny in cash proceeds. This brutal combination is literally going to force business owners to either liquidate core assets or take heavily taxed dividends from their companies just to generate the cash to pay the taxman. Section 5. Offshore trust protections vanish. And if you're thinking, I'll just use an offshore trust, well, those aren't the impenetrable shields they used to be either. For UK residents, the ground has completely shifted beneath your feet. In April 2025, the old non-dom regime is gone, replaced by a strict residence-based system. Offshore settlor-interested trusts are now totally look-through. This means UK resident settlors are taxed on worldwide income and gains exactly as they arise, whether the money comes to the UK or not. Once you've been a resident for 10 years, those offshore assets lose their protection and fall right into the UK inheritance tax net. The offshore shield has essentially evaporated.
Section 6. Diffusing the time bomb.
So how do we actually diffuse this thing? You still need to protect your wealth and plan for succession, right? Proactive management is the absolute priority here. Step 1. Do a rigorous line-by-line audit of your trust deeds. You simply cannot assume an old trust meets the new rules. Step 2. Review and tighten those exclusion clauses. Professional tip for you. Keeping meticulous records and strongly drafting clauses to permanently and explicitly remove your and your spouse's interest is absolutely crucial to avoid massive compliance issues. To get that CGT deferral, you really have to legally give up the potential to benefit. And step 3, get professional restructuring advice right now, long before those April 2026 deadlines hit. The rules we've discussed today are highly complex, strictly enforced by HMRC, and honestly, the penalties for getting them wrong are devastating. To successfully navigate these 2026 triggers without accidentally having to sell off your estate just to pay a dry tax charge, you really need expert, forward-looking guidance. Reach out to the seasoned tax advisors at Fairview Accounting Services. FVAS specializes in helping UK business owners, contractors, and property investors safely restructure their affairs. They know exactly how to balance your need for family control with total, uncompromising tax compliance. Please remember that the information in this explainer is intended as general guidance only. Tax law is incredibly nuanced, dependent on your specific assets, and always subject to change. Always get professional, personalized advice tailored to your unique circumstances before making any financial, legal, or structural decisions regarding your estate. So, I'll leave you with this final, absolutely critical question to consider. Is your family's legacy accidentally wired to a 24% dry tax charge? With these drastic changes to capital gains rates, the harsh £1 million cap on business reliefs, and the unforgiving rules around settlor-interested trusts, the private wealth landscape has fundamentally changed. Check your trust deeds today, because the financial cost of doing nothing in 2026 has literally never been higher. Thank you for joining us on this explainer, and make sure you take action to protect what you've worked so hard to build.